Yeah, sure. Look, and you're dead right. There's been a natural hedge going on with the exchange rate. So in Aussie dollar gold terms, we're still plus 1,600, which is a fantastic price considering a lot of the producers down here are sort of 1,000 to 1,100 type all-in sustaining costs. So it gives us really good margin. Look, there's certainly some pressure on the US dollar gold price. We are obviously entirely denominated into $8, so that's our key focus. From a Saracen perspective, look, frankly, we sort of plan for the worst, hope for the best. So we're building our mines around a lower gold price environment. If we get a higher gold price, we obviously get great higher margins. We can put more back into the ground like exploration we're doing now.
What's happening on the cost side of things? Because we know that cost inflation is starting to creep up a little bit, and that's having implications for mining companies in Australia. How quickly is that moving up, and how much of a headwind is it for you?
Yeah, look, it's not too bad. We're starting to see some early signs of it, and from Saracen's perspective, we got on early, locked in some of our contract rates over 4 years, anticipating that increase. Labour's becoming a little bit harder to identify, so we're putting a lot of effort into that from a Saracen perspective, also an industry perspective, to try and lock ourselves in with manning into the future. So early signs of it, but not huge cost pressures yet, but we try and work really hard to keep on control of that cost.
You have two main assets. You also have been out with some production updates recently. You saw record gold production over the 2018 year, and you say that you're on track for 400,000 ounces a year. When are we going to see that happen? Yep. And what could stand in the way of you not being able to achieve that guidance, or are you fairly certain that you'll hit that mark? Yeah,
look, we put it in a 7-year outlook, and we're at 350 is our committed level. We've got really good visibility into 400, and there's 4 key drivers on that. Expanding one of our mills, continue to deliver higher grade from underground, and record spend on exploration. So we're up to $60 million exploration spend this year, which is more than double we've ever spent in the past. That's giving us really good visibility to 400. We expect in the course of the next 6 to 12 months we'll be able to articulate that to the market on timing as well.
Yeah, talk to us about exploration, because that's something that's been lacking, I guess, in the gold space for the last years. It started to pick up in the last couple of years. How aggressive are you being on that front?
Yeah, like I said, record spend. So we spent 17 last year. We're going to spend 60 this year. So that's 3 times the spend. We're also getting sector-leading discovery cost per ounce. So the dollar we have to invest to find an ounce of reserve. So we're in a really good position there where you couple the two together, and hopefully we continue to see our reserves grow. We're at 2.5 million ounces at the moment, and we're targeting 4 million ounces. So it's a big step change, but we feel we've got really good visibility on our business, our assets, and our people to be able to achieve that target by FY23.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.